Hi and welcome back to the channel. In this video I'm gonna give you a complete guide on how to start trading Volatility 75 index and make a lot of money in the market potentially. So Volatility 75 index is one of the best instrument if you have a small account, and I'm going to talk about why is that. But in this video I'm gonna give you a complete step-by-step guide from what is Volatility 75 index, how do you get started trading Volatility 75 index, and I'm gonna give you a complete step-by-step strategy that you can use today to start trading Volatility 75 index. So let's start off by answering the question, what is Volatility 75 index? So Volatility 75 index is a synthetic index that is provided only for now by Deriv for their traders to trade. So this index is a computer generated instrument. So this is not a real market where a lot of people are going to be placing a lot of money, but it is a computer generated market that mimics the real world market. So the Volatility 75 index, as all the synthetic indices by Deriv, are a computer generated market, but they mimic the real world market. So the price action that works in real markets also works on synthetic indices, but the difference now is when you are trading like forex, you are trading in a market where the market is totally controlled by how people are buying and selling their currencies. But in synthetic indices, these are random generated numbers, but they form a market that you can trade. So there's advantages and potentially disadvantages of trading this market, since it is a computer generated market. But if you are trading a small account, this market is likely going to give you a lot of money, since this market is not controlled by human psychology, so it moves a lot. But we are going to talk about that in a minute. But now, how do you get Volatility 75 index? Because most of the people, you don't know about this instrument. So you go to a broker which is called Deriv. So as you can see here, I'm on Deriv Trader and I have an account with Deriv, and this account allows me to trade synthetic indices, forex, stock indices, cryptocurrencies, and even commodities. So Deriv offers a lot of instruments, but today we want to focus only on synthetic indices. So if you want to check this broker out, I'll leave a link in the description below. Once you go to this broker, you are going to go and open your account, and you connect this account to MetaTrader or any trading platform. You can even trade on their trading platform, the Deriv trading platform. So as you can see, these are all indices that you can get, but today we are going to only focus on Volatility 75 index. So make sure to check out this broker if you are interested in trading Volatility 75 index. So as you can see, Volatility 75 index, unlike other markets, there is a lot of reasons why you should trade this type of market. So the reason why I think you should trade Volatility 75, one of the reasons is there is high and constant volatility. So volatility indices are created based on the way they move. So the bigger number you have, like we have Volatility 10 index, is not very volatile as compared to Volatility 75 index, which means when you are trading on Volatility 10 index, the market is not going to be moving as fast as it does in Volatility 75 index, because there is low volatility in Volatility 10 and there is high volatility in Volatility 75 index. So now, why do you need a lot of volatility in the market? Because we know that volatility can make you lose money sometimes. So why do you need volatility in the market? So when you have like a small account, the reason that I created this video is I wanted to talk to the people who have small accounts. So if you have a small account, you want the market to move fast so that you can, number one, be able to place many trades so that you can grow that account. Also, number two, you want the risk to reward ratios in your trading, right? So Volatility 75 index gives you an opportunity to get big swings on trades in the market. So when the market is trading on currency pairs as compared to Volatility 75 index, there's a lot and a big difference on the market. So let's look into this market, and we are going to see that, look at the swings that you can see, look how much this market trends. So this market trends a lot. So if you compare this market to another markets like currencies market, you can see that for this currency market to make a move from this point right here, this big downtrend here, the last time this market was moving this much was in September. But now as I'm recording this video, we are in mid-November, and you can see that from October, the whole of October, and now almost the whole of November, we are still in a ranging market, which means you can never make a lot of money in this type of market. But if you are trading a bigger account, you can make big money, of course, on small swings of trades, because you have a bigger account and you don't need a bigger swing to make money. But if you look at this on Volatility 75 index, you can get a very big move. So let me show you an example. So if you look at this market, you're going to see that, let's say you were trading this and you buy here from this point that I marked here up to this upper zone here. This is 19,449 points that you can use. And also, if you take this one swing move, and this happened in like 6 hours, right? So starting from 2100 hours to 6 a.m., you can see that this move here created around 19,469 points, which if you use the minimum lot size, which you are going to talk about, the minimum lot size of volatility indices, this is was going to give you a $19 if you use a nano lot. But if you used a micro lot that we use in currencies, you could have made around $194 in this small move right here. But here I just used a nano lot, which is smaller than the minimum lot sizes of currencies, and you could have made all this money in less than 12 hours. So you can see how these big swing moves can help you get a big high risk to reward ratio and make a lot of money in the market. Now, the number 3 thing that I wanted to talk about is, if you are using Volatility 75 index, you can use a nano lot, and as compared to other instrument where you can use a micro lot. So since this market moves a lot, it gives you an opportunity to place a trades with a very small lot size, which means with a 0.001 you are placing like less than what is the minimum lot size for any other broker out there. And with this lot size, you can trade any account size, and you can potentially grow this account. For example, if you by any chance catched that move that I just showed you previously, you could have made $19 even if you had like $5 in your account. Why? Because you have a very small lot size to play with. So that's one of the reasons why you want to place your trades maybe using Volatility 75 index. So you can see here that using a very small lot size, if you are using a micro lot like what we do in synthetic indices, you can see that you can simply grow like a $500 account to a $2,000 with like 5 trades, and this will take you a very few minutes. Is it all a good thing, or there is also the other side of it? Okay, there's both parts to it, because that's why I wanted to say, okay, there's all these good things about this, but you need to be very careful, because this is a high risk instrument. Since you have an opportunity to make money as fast as possible, it doesn't mean that you necessarily make money as fast as possible. No, it doesn't work like that. The thing is, most of the time when people get a chance to make as much money as possible in a short period of time, they become greedy and they would place very big trades and end up losing money. I had a friend who grew a $75 account to about $2,000 in one day, and then the broker delayed to approve his withdrawal because of the country that he was living in. So the bank account and the broker, they had to negotiate. So instead of her waiting for the account to be approved and for her to withdraw, she went back into the market and she wanted to make more, but then she almost blew up the $2,000 account in the next day. Why? Because she was now using bigger lot sizes on a market that is very volatile. So when you're trading Volatility 75 index, make sure you use small lot sizes, and also make sure you have a strategy, you have your stop losses, and you know what you are doing. Understand price action, because this market respects price action, and I'm gonna give you right now a strategy that you can start using. The other thing that I wanted to talk about is position sizes and stop loss. How do you calculate your position sizes, and how much money are you risking per trade with the Volatility 75 index? Because this is something that most people struggle with. So for me, I just use a crosshair tool, as you can see on the screen right here. If you take the crosshair tool right here, and then you touch any or from where your price is at, and then what you do next is you are going to take another finger while you touch on your screen, and then you start dragging again. You're going to see 2 lines, and from your entry to where your stop loss is, for you to calculate the number of points from your entry to your stop loss, all you need to do is use this formula right here. So you're going to use this formula which says calculate the number of points from where you want to put your buy and where you want to put your stop loss. As you can see on the screen right here, I'm dragging my finger to see the number of pips from the entry to where this is right here. So I will try to point this on the edit of the video to point on where this number is. And then when you get to this point right here, you want to take this number, which is 4,919.28 points, and then you multiply this by your lot size, which is 0.001 as the minimum lot size here. So if I place this trade here, place my stop loss here, I'll be risking $4.19. So the formula is simple. Calculate the number of points from here. You can subtract this number of your buy and this number of your sell if you don't want to use the crosshair too, and then the difference that you get is the difference between the buy and the stop loss, and then you multiply that number with your lot size, and you are going to get the amount of money that you are risking in dollars. So that's exactly how you calculate your position size and how much are you risking per trade, and to know exactly where to put your stop loss depending on how much are you risking per trade. Now let's talk about the strategy that you can use right now to profit trading Volatility 75 index. So I'm gonna show you all the parameters of the strategy here, and then I'm gonna go ahead and explain the strategy, giving you the examples that you want to use, right? So first of all, the step one is identify higher highs and higher lows of your trend. So the good thing about this market is that this market trends a lot. So if this market trends a lot, it means that when the market is moving, it is gonna create clean price action, and you're going to be able to identify your trend. So first thing is identify higher highs and lower highs for the trend. Step number two is mark major levels of structure, or in other words, we call this OTZ or optimum trading zones. I learned this from fellow YouTubers, so I didn't invent these terms on my own, but I learned this from other players, right? So major levels of structure, or some call it optimum trading zones. Step number three is look for rejection candles around these major levels of structure. Then step number four is you enter, then you exit using a 3-to-1 risk to reward ratio. So you can take a screenshot of this before I explain to you how the strategy works. Okay, now assuming that you have taken the screenshot of the strategy, let me explain to you how the strategy works. Okay, so as we said, step number one is identify higher highs and higher lows, or lower highs and lower lows. In other words, I'm just saying you need to be able to read your trend and exactly know what is the trend doing at the moment. So how do you identify an uptrend? An uptrend is identified by higher highs and higher lows. So the market might be moving like this. So what do you call the higher high and higher low? First of all, this is called a higher high. Okay, so this is higher high. So the market reverses here, and then it goes to this level, and then you don't mark out this level at this point. You want the market to go up again and break past this zone here. If it breaks past this zone, you mark this zone here as a lower high. Once you mark this zone as a lower high, you let the market go up to a point where it starts to reverse back to this zone here. Once you see a clear reversal, the next thing that you want to do is you mark this new level as a higher high, and then you mark this zone as a lower high. Why do you mark this level as a lower high? Because this impulsive move managed to break past this higher high. So at the end of the day, you have higher highs, lower highs, higher highs, lower highs. So let me show you another example of a downtrend so that you can really understand this. So let's say you are in a downtrend. You want to see the market which is making an impulsive move, and then it pulls back, and when it pulls back, you mark this zone and you wait for the market to break below this. If it breaks below this, you also mark this zone here. This zone is going to show you a potential point to place your trades, which is going to be around this zone. So you want to wait for the pullback again, and then if this pullback, even if it goes all the way here, if it doesn't break past this zone, you are still in a downtrend. So this is a lower low, this is a higher low, and then you want to wait for the market to break past this new lower low here to confirm the downtrend. And then if the pullback comes back again like this, you want to make sure that it doesn't break here. If it breaks here, it goes to the other side potentially. So looking at the charts that you have in the market, let's try and read this trend together. So what the first thing that you see on this chart? First, you see that from this point right here, the market moved going to the downside. So we have a very strong move here up to this point. So we mark this zone, and then we see a pullback that comes to this zone that I marked here with a line. And then after that, what happens next? The market went down and breaks past this lower low. Now we confirm the 1, 2, 3 move. The downtrend is going. Next thing is we see a pullback. This pullback comes back, and you can see that the market is pulling back here. Now we are waiting for the market to break past this zone, and then it goes to the down downside. Why did I mark this red lines? This is the point that shows me that as long as the market doesn't break these lines going up, we are still in a downtrend, and I'm still looking for sell trades. So now what am I waiting for? So now step number 1 is done. You need to identify a clear trend. Volatility 75 is going to be trending a lot of the time, and it's easy for you to identify these trends, and I'm going to show you that in a minute. So now as you can see that the market have moved here. Step number 2, as I said, is find your support and resistance zone, or your area of value, or your optimum trading zones. And which are these zones? So we said from this point the market pushes down here, it makes a pullback. You mark this zone, it moves again down, makes a pullback. So this is an optimum trading zone. This is also an optimum trading zone, because this is the area where the market is reversing on going to the upside. So most of the time you will find out that the market will come back into this zone before continuing the downside, which creates now the strategy. And if you are a fan of this channel, you may start to see some similarities to this strategy. So what is the next thing that you do here is you want to mark our optimum trading zones. So do you mark all of them? No, you mark the recent one. For example, in this case, you mark this zone. Why this zone? Because the last time the market was in this trend, it reverses here, right? So now we are expecting a comeback here and a reversal point here. So as you can see here, the market moves up again, reversing and trying to collect all the orders that were in this previous zone right here. So the market likes to come back into this zone before it moves to the downside. So what do you do when you see the market coming back into this zone that you just marked out? The step number 3 is finding a rejection candle that shows you that this zone is rejecting now the market to go to the upside. As you can see, so we said the market moved like this, pulls back, goes up, breaks down, right, come back to this zone. So now we want to see if the market is not going up here. How do you see that? We find rejection candles at this point. And what are rejection candles? Rejection candles are candlesticks with long wicks and small bodies, and sometimes you can see bullish and bearish engulfing candles and other patterns, right? Sometimes you can even see a double top here. You can see the market doing something like this, and then you would wait for the breakout of this zone right here. But this is not the strategy. For now, we want to focus on rejection candles. As you can see on this zone right here, we have a rejection candle, which is a candlestick that shows you that the market is potentially going to push to the downside, and we place our sell trade there. We put our stop loss above this zone. If you have a bigger account, you can even put it above this previous zone that you marked red. Why? Because if the market breaks above this previous zone, this is where we say our trend have totally changed direction. But then if you have a small account, you are using tight stop loss, you can just put your stop loss above this zone right there, and then you expect prices to push to the downside. Sometimes it will not, but most of the time I guarantee you in Volatility 75 it does this. So let me show you another example. Now let's look at this market and let's try to identify the trend. As I said, it's easier to identify your trends in Volatility 75 index. So let's look from here. The market pushes to the upside, it makes a pullback. We mark this zone. We wait for the market to push up again up until it breaks here. We confirm this as a lower high. This is a higher high. And then we see a pullback right here. We haven't confirmed this higher high yet until we see again the market coming back up. Now we confirm the higher high. We confirm the lower high. And now we see the market pulling back down into this zone, which brings us to step number 2, identifying your area of value, which is right here. When the market comes back into the area of value, go to step number 3, look for a rejection candle. A rejection candle can be something like these two candles that you can see right here, which have long wicks to the downside, as you can see right there. It can also be a huge green candle, which is something like this, which shows you momentum of the market potentially going up. Once you see that, place your buy order, place your stop loss below this zone, and your take profit always 3 times 1 risk to reward ratio. This market trends a lot. You should never be afraid of using a high risk to reward ratio. In this case, since this is an example, the market went on to win. You can see that the market also went up and came back into this zone again, and then created the same thing again here. Let's look at this. You can see the market created the same thing again here, right? As you can see here, created another rejection candle, and then it went all the way up. So you could have placed again another trade here using the same strategy. Now let's look at another example, and then you can really see that this happens a lot in the market. So here, what is our trend here? We see the market pushes up here, and then it did something like this, and then from here is where it started to do something that interests me. So because for me, when you look into the market, you just want to look at where the market is at. Look at the few candles going down and try to identify that trend. So push up here, a pullback, a push up again, breaking past this zone. This is our high, and then we have a break, a retest, push up again, and now we have a retest, we have a high, we have this high, but this is not confirmed yet because the market haven't broken it up. But now the market have come back into our previous level of structure, a previous level which we marked as a high, which is this zone right here. And this zone is also good enough because the market have tested it more times. Now if it have broken it and coming back, and look at what happens here, what do you see? Rejection candles, which is exactly what we are talking about right here, right? So once you see this, what do you do next? You place your trade, your stop loss below the candles and below this zone, and then you take profit 3 times your risk. In this case again, the market went on to win in this case. So this strategy works a lot, and if you manage to get 2 or 3 of these trades per day in the market, I guarantee you that you probably start seeing profits in the market. So to show you that this strategy works, I'm just going to show you one chart with all the examples that I found. So just to show you that this strategy works, you are going to see that all these are the trades that you could have placed on one chart of Volatility 75 index, and from all these trades you could have potentially lost one or none of this. And I'm not saying this is a holy grail strategy. No, I'm not saying that, but I'm saying that if you know what you are doing with this strategy, since this market trends a lot, you can potentially place a lot of winning trades using the exact strategy. Now that I've shown you how to trade Volatility 75 index and I've given you a simple strategy that you can use, I want you to do me one favor. Like this video if you really enjoyed it. If you think that this video was not helpful, let me know in the comments. I don't mind it. I will read all the comments and hear what you have to say. For now, if you want more details on how to trade different markets and combine all these strategies to create something or a system that you can use in the market, watch this video appearing on the screen, because I'm going to show you 11 price action strategies that you can start using. So make sure you check out this video appearing on the screen right now.